Click the bell icon to get latest videos from Ekeeda.
Hello friends, today we'll be discussing one question of marginal costing where we are required to calculate break-even point based on PVR and margin of safety. Profit volume ratio of a company is 50%. So PVR is given in the question 50%, while its margin of safety is 40%. Margin of safety is given 40%. If the sales volume of the company is rupees 50 lakhs, find out its break-even point and net profit. So we are required to find out here break-even point and net profit based on the information. So actual sales here we have 50 lakhs. Let us proceed now. Break-even point is equal to actual sales percentage of margin of safety in relation to actual sales. Here we have actual sales 50 lakhs, percentage of margin of safety they have given, while its margin of safety is 40%. This 40% will be calculated on this 50 lakhs. Actual sales 50 lakhs minus percentage of margin of safety, that is 20 lakhs. We got here break even point 30 lakhs. Next we are required to find out amount of net profit. So your formula will be percentage of margin of safety to actual sales multiplied by PV ratio. Actual sales 50 lakhs, percentage of margin of safety 40%, multiplied by profit volume ratio 50%. So 50 lakhs multiplied by 40%, it's 20 lakhs multiplied by 50%, so net profit amount is 20 lakhs multiplied by 50%, that is 10 lakhs. So in this question we have understood based on margin of safety how we can calculate break-even point and amount of net profit. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda.